Okay, let's look at volatility smiles. So the reasons for existence of volatility smiles, how volatility affect option pricing as well as other option characteristic. Focus on why volatility smile exists in currency and equity option and how volatility smile impacts Greeks and what's price jump. So if we recall the put call parity, which is a no arbitrage equilibrium relationship that exists between European call and put prices to the underlying asset price at the present value of the option price, and something called the put call parity, which means that on the left hand side, if you purchased a call and with that you purchased you hold a bond and versus you purchased the stock and you bought the put, you will get exactly the same thing. And since the put call parity is a no arbitrage relation, it will hold when underlying price distribution is log normal as required by Black-Scholes option pricing Morton model. And if we rearrange that thing, we get a relationship where the market price minus price of Black-Scholes is equal to call price of the market minus call price of the Black-Scholes. Now this relationship shows that with the same strike price time to expiration option market prices that deviate, Black-Scholes options are going to deviate in the same amount whether they are for call or for put. So any deviation in price will be the same, which means that the implied volatility of call and put will be equal for same strike price and time to expiration. Now, what are volatility smiles? Actual option pricing in conjugation with Black-Scholes model can be used to generate implied volatility, which may differ from the historical volatility. When option traders allowed implied volatility to be dependent on strike price, the pattern implied volatility is generated, which resembles volatility smiles. These curves display implied volatility as a function of option strike price. Now, the smiles for both currency and option pricing are different. In case of an equity option, the volatile smile is sometimes referred to as volatility skew, and the volatility pattern for equity option is essentially an inverse relationship. So, currency options. The volatility pattern used by traders to price currency option generates implied volatility that are higher for deep in the money and deep out of the money as compared to implied volatility which is at the money. The easiest way to see why implied volatility for away the money option is greater than at the money is to consider the following put and call option where the call price is going to pay off if the actual rate is above the strike price, where the put will play when the currency price go uh, beyond the off price, and so on. So if the implied volatility for actual currency options are greater for away the money, then at the money the currency traders must think that there is a greater chance of extreme price movement dictated by log normal distribution. Now, there have been many empirical evidence to suggest that this has been happening. The tendency for exchange rate changes to be more extreme is a function of the fact that exchange rate volatility is not constant and frequently jumps from one to another. So what we need to understand is that volatility is not constant and the volatility jumps. This became a sound starting for what's called the jump diffusion model, again that comes into credit risk from pricing some of the equity pricing for the future. So that was it. So however, if you were to model Black-Scholes and you were to change things for your own adjustment and find out the pricing of call option, you can use jump diffusion model for equity pricing. Another option, which is the Brownian motion for calculating the future expected prices, that's used for Black-Scholes. So uh, after this part came into being, and then we use different kind of an options. So these two effects tend to mitigate for long dated option which exhibit volatility smile for short dated options. So this was all for currency options. Now let's move for the equity option. For the equity option, volatility smile is different. The smile is more smirk or skew that shows a higher implied volatility for low strike price than for higher strike price options which are call. So there is essentially an inverse relationship between implied volatility and strike prices of the equity option. So the implied volatility is decreasing all the time. The volatility smirk exhibited by equity option translate into a left skewed implied distribution of equity price changes. This left skewed distribution indicates that equity traders believe that the probability of large down movement is higher than the probability of large up movement as compared to with log normal distribution. The two reasons that kind of brings to this phenomena is leverage and crashophobia. When the equity value decreases, the amount of leverage increases, which essentially increases the riskiness or the volatility of the underlying asset. When a firm equity increases in value, the amount of leverage decreases, which tend to increase the riskiness of the firm. The lower of the volatility of underlying assets. All held constant, there is an inverse relationship between volatility and underlying assets valuation. Then the second is claustrophobia. Now, since 1987, stock market crash was coined as claustrophobia. Market participants are simply afraid of another market crash, so they place a premium on the probability of the stock market price falling precipitously. So, deep out of the money will exhibit high premium since they provide protection against substantial drop. There is some support for this claustrophobia hypothesis because volatilities tend to skew when equity markets decline, but it is not noticeable when equity markets increase in value. Now we move to the next part, which is alternative methodology for studying volatility smiles. The volatility smiles we have characterized thus so far have examined the relationship between implied volatility and strike price. Other relation exists which allow traders to use alternative methods study for these patterns. Now these replacement of independent variable and strike price. One alternative method involves replacing the strike price with the strike price of dividend by stock X upon S naught. This method result in more stable volatility smile. A second alternative is to substitute strike price with the strike price uh, divided by the following strike price X naught X by F naught. I'll come into this probably in some time, but the whole idea here is to replace the strike price and divide it by S naught or F naught. So the forward price would have the same maturity as the option being SS. Traders sometimes view the forward prices as better gauge of at the money price option since the forward price displays theoretical expected stock price. A third alternative method involves replicating strike price with option delta. So with these approaches, traders are able to study volatility smiles of option other than European and American options. Now let's look at volatility term structure and volatility surfaces. A volatility term structure is the listing of implied volatility as a function of time to expiration for the money contract. When short dated volatilities are low, and volatility tends to be increasing function of maturity, and when short dated volatility is high, the volatility tends to be inverse function of maturity. This phenomena is related to but highly different meaning from the mean reverting characteristic often exhibited by implied volatility. So another interesting thing here is that if you remember in the interest rate we also talked about something called the mean revert phenomena, and the mean revert phenomena is also applied to volatility. So there are different models that we use for different aspects. So I just talked about a few moments ago about the jump diffusion model that we will prefer for equity modeling, which believes that there could be a jump in the volatility, and for the volatility modeling we use the mean reverting models more often. So when the short dated volatilities are low, volatility tend to be as an increasing function of maturity, and when the short dated volatility high, volatility tends to be an inverse function of volatility. Volatility surface is nothing other than a combination of volatility term structure with volatility smiles. The surface provides guidance in pricing option with strike price or maturity structure. A trader's primary objective is to maintain a pricing mechanism that generates option price consistent with the market pricing. Even if the implied volatility, all the model pricing errors change due to shifting from one price to another, which could occur if the traders use an alternative model to Black-Scholes. The objective is to have consistency in model generating prices. The volatility term structure and vertices can be used to confirm or disprove model accuracy and consistent pricing. So whatever models they are using, whether they have moved from Black-Scholes to a jump diffusion model or whichever thing, the main idea here is to use Black-Scholes so that we remain consistent with the pricing of our volatility from the options that are traded in the market. Then we move to the option Greek. The option Greek indicates expected changes in the option pricing given change in the underlying factors that affect the option pricing. The problem here is that option Greeks including delta and vega may be affected by implied volatility of an option. Now if we remember that these are guidelines for uh, how implied volatility may affect the Greek calculation of an option. The first guidance is sticky strike rule, which makes an assumption that option implied volatility is same for short period of time. If this is the case, Greek calculation of an option are assumed to be unaffected as long as implied volatility is unchanged. The implied volatility changes, the option sensitivity calculation may not yield the correct figures. Then we have the second rule is called the sticky delta rule, which assumes that the relationship between an option price and ratio of an underlying to strike price applies in subsequent periods. The idea here is that implied volatility reflects the moneyness of the option, so delta calculation includes an adjustment factor to implied volatility. If sticky delta rules hold, the option delta will be larger than that given of the Black-Scholes formula. So we have two rules here: sticky delta and sticky strike rule. So I repeat my point here. So if in the Greek calculation we assume that uh, the option are unaffected as long as implied volatility is unchanged. But if implied volatility changes, the option sensitivity calculation may not yield correct figure. So that's the sticky strike rule. And the sticky delta rule, which assumes relationship between an option price to a ratio of underlying to stock price in subsequent period. The idea here is that implied volatility reflects moneyness of the option, so delta calculation includes an adjustment factor for implied volatility. So we have to keep in mind that both rules assume volatility smile is flat for all options. This is not the case. Rules may be internally consistent and to correct for a non-volatility smile. We have to rely on implied volatility function or tree to calculate the correct option Greeks. Now let's understand the impact of asset price jumps on volatility smile. Price jumps can occur for a number of reasons. One reason may be expectation of significantly new events that causes the underlying assets to move in either up and down. This would cause the underlying distribution to become bimodal, but with the same expected return and standard deviation as a unimodal or a standard price distribution. Implied volatility is affected by price jump and the probability assumed for either a large or uh, down movement. The usual result, however, is that at the money option tend to have a higher implied volatility than either out of the money or in the money option. Away from the money option exhibit a lower implied volatility than high at the money option. Instead of volatility smile, price jump generate a volatility frown. So if there are chances that anything uh, uh, expectation of a news or something like that is happening, then remaining at the current thing is something that's everybody want to. So there would be a frown. So frown would happen when there is a price jump and when there is a news coming into the market, or the market is they are expecting a price would go up on either side, so everybody would buy that option. And the price jump and the probability for up and down movement. So the implied volatility is affected by the price jump and the probability assumed for either a large or an up down movement. The usual result, however, is that at the money option tend to have higher implied volatility than either out of the money. So away from the money option exhibit lower implied volatility than at the money option. So this is known as volatility frown with a price jump. So I think that was it for the volatility smiles. I hope this was helpful and added to your knowledge base. Thank you for listening. And here is a revision of what we talked about. So put call parity indicates the implied volatility, shape of volatility to the shape of implied distribution of the underlying asset. And foreign exchange rates are not log normally distributed, and they have a volatility smile, whereas the equity has volatility skew, and the impact of asset price jumps makes it frown. So that was it for this lecture. Thank you for listening.